On behalf of our team at HBK, I'd like to welcome you to Cannabis 280E and Delta 8 webinar with HBK Cannabis Solutions, Chris Mari. Our session is scheduled for 60 minutes and is being recorded. Please note that all attendees are set up in listen-only mode. We'll be answering questions at the end of the session. If you'd like to submit a question to our panel, please use the question box in the GoToWebinar control bar. A copy of the presentation materials is available for download in the handout section of the GoToWebinar control bar. Please make sure to complete our short survey on today's session after the webinar concludes. For more information and insights, please visit our Cannabis section of our Insights page at hbkcpa.com/insights. At this time, I'd like to turn it over to Chris.
Thank you very much, Michelle. Good morning, everyone. Thank you very much for making the time to sit through our presentation this morning. As Michelle mentioned, I'm the director of our Cannabis Solutions Group. I work exclusively with cannabis businesses throughout the United States, even some abroad. It's all that I've been doing now for at least the last 3 years. So we're certainly not dabblers in the space. We've been all in for a while, and we've seen a lot of different things over the last 5 to 6 plus years as the industry's evolved, as the government's position on the industry has continued to change or not change. And so I thought this would be a really interesting topic for this morning. There's one of the areas that I still think there's a lot of ambiguity is the sales of Delta 8 products. And so I thought this would be an interesting topic. I'm not necessarily going to tell you that I can give you any definitive answers at this point because I just really don't think that they exist. I think there's a lot of people who would take positions maybe contrary to some of the thoughts that I have. I don't know that there's any right or wrong answer, but I think it's important that we're considering all the possibilities anytime we enter into any aspect of the cannabis industry. I've never been one who likes surprises, and I can tell you that it's better to be prepared for the worst and hope for the best, even if it's a remote possibility. And that's sort of been my approach to how we view Delta 8 sales in our practice. One of the things that we'd like to do is maybe just kind of set this up and get everyone at least a little bit familiar with what the tax challenges are in the industry and what that really means if you're an operator. If you haven't experienced it before, it's not like anything that I've ever dealt with in my career. And I can't imagine as a taxpayer what it's like to go through this process if you're really not prepared for what it looks like. So the first poll question we had is just, are you familiar with the application requirements of in the requirements of Irc Section 280E? And we'll give you just 1 minute to answer that question. Okay, so it looks like we're kind of about 50-50, so that's good. I think that, some people who have some experience with it, you'll know a little bit more what we're looking at, and then we'll spend a few minutes just kind of explaining some of the aspects of it for those who haven't experienced it or aren't familiar with it and what it's going to mean. You can move to the next slide, please. So just to be clear on the difference between the application of this provision of the tax code. In 2018, there was a farm bill that passed at a federal level, and basically it made a distinction between what the government has generally considered to be marijuana and what is considered to be hemp. So if hemp has less than 0.3% THC content tested at its dry weight, then it falls under compliance with the farm bill and is considered to be completely legal and not a controlled substance. If it doesn't pass this test, then it would fall into the other category, and the federal government would still consider it to be a Schedule 1 controlled substance. There's a very important distinction there, and the interesting thing is that there's some conflicting views in how Delta 8 kind of falls in compliance with this. the government sort of handcuffed themselves a little bit with the Farm Bill because they very specifically identified Delta 9 THC as what's tested for the 0.3% threshold at dry weight. So if you're just looking at Delta 8 in a vacuum, it's been specifically kind of excluded from that Farm Bill. But what I've learned working in the cannabis industry over the last several years is there is a lot of differing opinions in different branches of government, and they're not necessarily always synced up. You can move to the next slide, Michelle. Thank you. So just to clarify what the distinction is CBD, which is generally derived from hemp, is not psychoactive. It's legal at the federal level. It's completely just a derivative of the plant. There's no conversion process or anything it really undergoes. It goes through an extraction process, and you're just pulling out something that naturally exists in the plant at very high levels. THC is psychoactive. It's found in both cannabis and hemp plants, and it is illegal at the federal level. This is really what the government has generally targeted as being a Schedule 1 controlled substance. It's what it considers to be the psychoactive components of the plant. Again, very important distinction because this really determines whether or not you are potentially compliant with the Farm Bill at the federal level or you're not. And you can move to the next poll question. So just to give a little bit of context to who's on and who's listening, are you currently manufacturing or selling Farm Bill compliant CBD products? And we'll give you just 1 minute to answer that question as well. Okay, so there's some people on who are currently engaged in this line of business. You can move to the next slide. So just some clarity on what the Controlled Substances Act says. If you're a Schedule 1 controlled substance, a Schedule 1 controlled substance is a drug that the government considers to have a high potential for abuse. There's no currently accepted medical use in treatment in the United States, and there's a lack of accepted safety for use of the drug or other substance under medical supervision. That is where THC falls. It's considered to be a Schedule 1 controlled substance. The IRS provisions apply to both Schedule 1 and Schedule 2 controlled substances, but I'll generally focus just on the Schedule 1 component here because that's really what we're talking about. Just to give a little bit of context, because I know as we get into the Delta 8 component, of this presentation, there's been a lot of conflicting positions coming from the federal government, depending on which branch of the federal government they're coming from. A few weeks ago, the DEA issued a memo that I think a lot of people felt was very favorable to the sales of Delta 8. However, I'm not so sure that that's exactly correct. And as of November 2021, Delta 8 THC is still specifically listed by the Department of Justice as a Schedule 1 controlled substance. So the Department of Justice hasn't moved off of their position at all at this point. You can move to the next slide. So as we start to talk about how this impacts us as taxpayers, in pretty much any business that you can think of, we are allowed a deduction for what are considered the ordinary and necessary expenses paid or incurred in carrying on the trade or business. So not only do we have expenses that or costs that we incur to manufacture or purchase inventory, what we consider to be cost of goods sold, what we pay or the costs we incur to actually develop or attain the product that we're ultimately going to sell to the end user. On top of that, we generally have selling expenses, different types of overhead. We probably rent administrative offices. There's a number of other costs that go into running a business that aren't directly allocable to your inventory. In any trade or business, you are allowed to deduct all those costs, assuming that they're ordinary and necessary. So in other words, you can't have a frivolous, travel expenses that are clearly just benefiting the owners of the business. Those would be considered personal. That's always going to be sort of what would be considered, non-deductible. But if they're ordinary and necessary to conduct the business, then you get a tax deduction for them. This is not the case in the cannabis industry, and it creates tremendous headaches and tremendous cash flow restraints for operators. Okay, you can move to the next slide. So this is IRC Section 280E, and this is the provision in the tax code that we need to be concerned about if we're involved in what the government considers trafficking a Schedule 1 or 2 controlled substance. So if you, for example, have in Florida an MMTC or medical marijuana treatment center license, you are able to sell medicinal cannabis, and it's perfectly legal the way you're operating at the state level. However, the federal government's position is it's still a Schedule 1 controlled substance. So as an operator in that industry, you are going to lose a majority of your deductions for anything that would be considered to be SG&A, overhead, selling expenses, anything that's not a directly inventoriable cost, you will lose a tax deduction for. If you are operating in compliance with the Farm Bill and you're selling, for example, CBD products that are Farm Bill compliant, this provision of the tax code does not apply. That's not considered to be a controlled substance, and this is not something that we've generally had to deal with. To give a little bit of context to what we've seen just generally as it comes to enforcement of this provision, as you can see here, there's not a lot written down. The enforcement around this provision it expands far beyond what's written here on this slide and what the code says. It's become subject to interpretation. There have been a lot of tax court cases that have generally been unfavorable to the taxpayer. And so the enforcement around this has really grown over the past several years, and it's become much different than maybe what a lot of people anticipated or interpreted early on when we started to see states roll out medicinal cannabis programs. To give a little bit of context to where this provision came from, so back in 1974, there was a tax court case. There was a taxpayer named Jeffrey Edmondson in Minneapolis who was arrested for drug trafficking in marijuana, methamphetamine, cocaine, and I believe maybe some other pharmaceuticals. So, had a lot going on. He was arrested, and he was charged at a federal level with drug trafficking. And one of the things that the government decided to do was enforce, just like, for example, this is exactly how Al Capone ended up in federal prison. They decided that this particular individual needed to file tax returns. And, regardless of what anybody thinks of Mr. Edmondson's character or his ethical decision making, apparently he was pretty good at reading and interpreting statutes. He actually was able to put together and file credible tax returns for his business, and he took what he believed were ordinary and necessary business deductions for everything that he had done. The IRS took him to tax court. They wanted to disallow all of his deductions, and he actually was successful in tax court in convincing the court that he was in compliance with the tax code and federal law and how he was filing his tax returns. The only deductions that he lost, he had a couple of travel deductions that he couldn't substantiate that he lost, but for the most part, the tax court agreed. And so, as a result of that, Congress passed what we now have in what is now known as IRC Section 280E, which made sure that nobody would be able to do, again, what he was able to accomplish in his income tax filings and his court case. You can go to the next slide. So polling question 3, I think maybe, the last one kind of narrowed it down. There's only a few people on the call that are currently in the business of manufacturing or selling CBD products. So just out of curiosity, how many people are currently manufacturing or selling Delta 8? And we'll give you a minute to answer that question. Okay, so very similar to the last polling question, and this is kind of, I guess, what I would expect at this point. Most of the people that we've worked with who are in the business of any Farm Bill compliant CBD sales, I think have participated in some way, probably manufacturing or selling Delta 8 as well. It's become a big part of the industry, and so that's kind of, I guess, what we would expect. I want to be able to give you a little bit of context before we move into how specifically Delta 8 potentially could be impacted by the tax code and what the positions are. I want to set the table a little bit for what the application of Section 280E really means for a business. So these next couple of slides, they've been rate adjusted just for some of the things we think may happen. So right now, current tax rates are a little bit lower than this, but at the end of the day, you'll see what an adjustment could potentially mean to any taxpayer. So as you walk through this, if you look at the non-cannabis business, if we have revenue of $1 million, we're incurring cost of goods sold of $500,000. So anything else that we're, call it selling, producing, manufacturing, any business that's not considered to be a 280E business, you're going to have a gross profit of $500,000. The operating expenses, let's say that you incur, are about $300,000. So your pre-tax income is $200,000. If we assume in the future you were going to have as a C corporation a 28% tax rate, your income tax liability is going to be $56,000. In theory, you would have about $144,000 in free cash flow that would then be able to be reinvested in the business or distributed to the owners of the business. If 280E applies to the business, we get a very, very different result. And as you can see here, this is highly negative for standalone retailers. It's a hit for manufacturers and cultivators, but for standalone retailers, they take a severe hit because of 280E. And I think that's important to note because a lot of the businesses that we work with who are currently selling Delta 8 are standalone retailers. So they're a little bit more at risk to have a really negative impact from an adjustment to their tax return based on Section 280E. So if we walk through a manufacturer or cultivator, same revenue, their cost of goods sold are generally going to be higher because what's going to happen if you're only making wholesale sales and your business is primarily production or manufacturing, cultivation, you're going to have higher cost of goods sold and lower operating overhead expenses. So the pool of costs that is potentially exposed to a 280E adjustment is going to be much lower for a cultivator or manufacturer than it would be for a standalone retailer. So in this example, you can see we're assuming a little bit lower gross profit because you're going to have higher cost of goods sold. However, at the same time, we're expecting your operating expenses, or call them quote unquote below the line deductions, to also be lower. So you're ending up with pre-tax income of about $200,000. The income taxes are going to be assessed on the gross profit. So you're going to lose the deduction for the $100,000 of operating expenses. The tax rate's going to be applied now to the gross profit. So you're going to have a higher tax liability than a non-cannabis business. You're going to have about an $84,000 tax liability, and now only $116,000 available either for reinvestment or potentially distribution to investors and owners. When we move over and look at the retail, this is where the big hit comes. In a retail business, really the only deduction or the only costs you're going to incur that are going to be considered cost of goods sold is essentially what you pay for your inventory. So whatever you pay wholesalers for inventory, any shipping costs to get the inventory in, you could capitalize into your cost of goods sold. Those would be considered inventoriable costs. But at the end of the day, once that happens and you buy the inventory, the rest of the deductions are likely to be lost. So you can see here, we're looking at a dispensary doing $1 million in revenue. $500,000 is considered to be cost of goods sold. They have a gross profit of $500,000. Their operating expenses are now higher. If you think about any retail space you walk into, there tends to be a lot of employees. You're also going to either own some sort of retail space or pay some kind of rent. All of these costs now are going to be considered non-deductible. So they're ending up with the same pre-tax income as the cultivator, manufacturer, or the non-cannabis business. But as you can see, the tax liability that a retailer is going to incur is going to be significant. So out of the $200,000 of net income, there's only $60,000 left for reinvestment or distribution to owners. You can see that the tax is going to be assessed on $500,000, not $200,000. This is a really difficult adjustment, and we see this all the time working with clients. You could very easily end up early on as a retailer in a position where you're cash flow negative, but you still have very, very large tax liabilities because you're not getting any of these operating expenses as deductions. Okay, you can move to the next slide. To give a little bit of context now to what that means for a pass-through taxpayer. So in the last example, we're looking at a C corporation. The C corporation pays tax on its own at the entity level, and then any distributions that are pushed out to owners are considered dividends, and then they pay tax on those separately. Where most small businesses are structured, they're going to be pass-through taxpayers. So essentially, the owners of the business are going to pay all of the income tax, and any distributions made to those owners in cash are not taxable because they've already paid tax on the actual income of the business itself. In this particular example, if we start with the non-cannabis business, we're assuming a $1 million revenue, sales revenue level, and the cost of goods sold, again, same numbers, $500,000. You can see that when the income tax is assessed, and again, we're at a higher tax rate now because we're not at a C corporate, we're assuming a little higher tax rate than we have in the past and possibly some self-employment tax here that is going to be pushed out. So worst case scenario, let's say you end up paying about $84,000 in income taxes. Again, you've got $116,000 left for reinvestment in the business or distribution to shareholders. In some cases, that tax rate may even be lower. As we move over again to look at the cultivator and manufacturer, same numbers, but they're back to paying income taxes on the $300,000, not their pre-tax income of $200,000. They're again taking a bigger hit. They're going to pay about $126,000 in income taxes and only have $74,000 left over. Their effective tax rate now is 63%. Now, when we look at a standalone retailer, same numbers. We've got $500,000 in cost of goods sold. The income tax is going to be assessed on the $500,000 in gross profit. They're going to lose their operating expenses as deductions. In this particular example, they end up with an income tax liability that's actually higher than their pre-tax net income. So in theory, if we assume that all of their pre-tax income was free cash, they're not going to have enough cash on hand to pay their tax liability just based on how 280 applies to the business. It's a very negative result. It's very frustrating, and it can be challenging to operate in this industry because of it. It's an industry that's capital intensive. It takes a lot of money to get started, and when you're handcuffed with an income tax result that looks like this, it just makes it increasingly challenging, if not almost impossible at times, to really get up and running and to grow the business the way anybody else would want to grow their business. So the reason that I think it's so important to understand this, as I said earlier, I don't like surprises. And if I was in a business where I had no idea that this could potentially be applied, I would want to know what was out there and what the potential pitfalls were. And we'll talk a little bit as we move through the presentation on how maybe sales of Delta 8 could create some exposure to this provision of the tax code and what that could mean for different taxpayers depending on what your business is. So this is very important to note, and this is where you may have a lot of differences in opinion on what the potential exposure to selling Delta 8 may be. So hemp is not subject to 280E if the following conditions are satisfied, and this was part of the Farm Bill. So if we've implemented an official agricultural pilot program allowing the cultivation of industrial hemp in the state, which, for example, Florida did, and any other state that has a hemp program did, and any part of the cannabis plant has less than 0.3% THC on a dry weight basis, if you're in compliance with the Farm Bill, you are excluded from 280E, and it's not going to be applied to your business. And that is really, I think, where we've seen most of the positions that have been taken with Delta 8 come into play. And so to kind of pivot over and start to talk about that a little bit, there's conflicting rulings or, opinions or position statements that have come out of the federal government regarding Delta 8 and cannabis in general over a multitude of years. Where we've really seen Delta 8 grow exponentially, I think, has been in 2021. If you go and you just look at what the CDC and the FDA have published related to Delta 8, most of what they've put forward to the public as far as advisories, warnings, things like that, almost every single one of the reported incidents to the CDC, the FDA, or poison control has happened in 2021. In fact, I think the CDC said that they logged 661 reports of some adverse reaction to the use of Delta 8, whether it was reported by an emergency room, a hospital, by law enforcement, or by someone who's ingested Delta 8 themselves. Out of the 661 that they logged, I think they said 660 of them were in 2021. So it's become an increasingly hot topic. And early on in 2021, it seemed like the position of the DEA was going to be highly antagonistic towards the sales of Delta 8 products, period. They conducted some raids. They've really put out a lot of positions that they did not consider Delta 8 to be Farm Bill compliant, that it's a synthetic. Any synthetic form of THC they consider to be a Schedule I controlled substance, and that was their position, and they really didn't seem to be backing away from it at all. As we've sort of moved through the process here, and we've seen a lot of states move around, and some states have completely banned the sales of Delta 8. Other states say they're studying it. They haven't made a decision yet. Other states like Florida, my understanding it's currently legal, and I know there have been some movement. I don't know if it's within the legislature or regulators to maybe change their position on that. But as of right now, you can still sell it here. I'm not, an expert in any of it, the legalities of whether you can and can't sell it or what the various states have done in that regard. But I will say that I've tried to follow what the DEA and the Department of Justice have been doing, because the IRS has really taken no position on it at this point. And so, just trying to be prepared for, call it worst case scenario, what could happen. I've really tried to follow what they're signaling, because I think that if you look at what 280E says, the government's position, whether it's the DEA or really the Department of Justice, on whether or not Delta 8 is a Schedule I controlled substance, very clearly would dictate what level of enforcement the IRS could engage in. So about a month ago, I believe the DEA issued another opinion to a state, and I don't recall whether it was Texas or Alabama. I think it may have been one of those two, where they really clarified what their position is on Delta 8 and their enforcement surrounding Delta 8 and how they've interpreted the Farm Bill. So for a lot of people who have been operating in the cannabis industry, particularly in the hemp space, this was a positive movement by the government, because what the DEA basically said is that they acquiesced that Delta 8 is in fact covered by the Farm Bill, assuming that you are compliant with all other aspects of the Farm Bill. They also said, which was interesting, that synthetic derivatives of the Farm Bill compliant hemp are also covered by the Farm Bill, assuming they're produced exclusively from, quote, cannabis materials, end quote. And if that's the case, they're not a controlled substance. And I think most people in the industry viewed that as the DEA basically saying, we're going to completely back off on Delta 8 enforcement. I'm not so sure that's the direction they were going, or if this was really just very carefully worded language. My experience over the past 6 years in dealing with the federal government when it comes to the cannabis industry overall is they've taken a very hostile and adversarial approach to anyone who's operating in the industry. And for them to make that quick of an about face and reverse their position, I would be really surprised if that's the direction this is going. So what I think would concern me a little bit, if you look at what most Delta 8 products in the United States are, Delta 8 naturally occurring in hemp is, in my understanding, very low quantities. So you're not generally going to be able to extract enough Delta 8 on its own to have a viable business just naturally extracting Delta 8 from hemp compliant or Farm Bill compliant hemp. So generally it's what happens is CBD is extracted, it undergoes a conversion process using solvents and acids, and this is what the DEA has always called quote unquote synthetic conversion. And the question then becomes is once you start using these solvents and these acids to convert CBD into Delta 8 THC, are we still using only, quote, cannabis materials, end quote? That's the piece that would concern me still as I look at what the DEA's position is based on what language they put forward. And they've been very clear that they consider any quote unquote synthetic form of THC to be a Schedule 1 controlled substance. I went and looked because, again, this came out, I believe it was in November, and there was a lot of, positive reaction in the cannabis industry to the DEA's position. So I went and looked at the Department of Justice just to see where they were still standing on the controlled substance scheduling, and they specifically, as of November, still had Delta 8 listed as a Schedule 1 controlled substance. So while I think it's encouraging that we've seen some movement on this by the DEA, I'm still not 100% convinced that we're not going to have additional challenges going forward, or that the IRS is not going to take a position that could be very negative for anyone who's currently selling Delta 8 products. So I want to just talk a little bit about what the experience has been with IRS enforcement when it comes to 280E. And I know when we started, there's a lot of people who are on the call who, number one, are not familiar with 280E at all, and have certainly never lived through the enforcement. And I know we have some other people who have. I can tell you that the enforcement around this provision of the tax code has been aggressive, and I would just editorialize and go far enough to just call it flat out unfair at times. The IRS has generally taken very rigid, hard-lined, and very cumbersome positions on how they've enforced this provision of the tax code. What we've really seen happen, and this is what always happens when you're dealing with the IRS, they know that bad fact patterns create bad case law. And they've been very selective about who they've audited and taken all the way to tax court. And they've been very successful in picking cases where the taxpayer had bad fact patterns, going all the way to the tax court and getting very, very favorable rulings for the government from the tax court. The unfortunate part of that is that once that happens, that's kind of what we're all stuck with and that we have to live with when it comes to interpretations of 280E. So, a lot of things that people have been able to do in the past, they can no longer do. And the rulings that have come down have not really created any opportunities for creativity or interpretation of how this applies to businesses. So, having been through this with the government, you can call me a pessimist. I am not optimistic that they're going to act necessarily in good faith or do exactly what maybe we're interpreting the DEA is saying. I don't know that's exactly how it's going to come in to play here. We lived in an environment in cannabis several years ago where it wasn't a matter of if you were going to be audited, it was a matter of when. And I think it was the IRS office in Denver that even announced publicly they had a plan, I think, to audit every single cannabis business in the state of Colorado once every 3 years. That was the plan for enforcement. What's happened over the last couple of years, and so over the last, call it 10 years, funding for the IRS has declined exponentially. It's come way down. So they were already operating very lean. When the pandemic hit, the IRS really took a huge blow to what they were able to do in terms of just administration, let alone enforcement. And what we found is that generally enforcement has been sort of non-existent over the last couple of years. It doesn't mean that nobody's been audited, but the number of audits that we were seeing have completely fallen off. And I would caution all of us, those of us who have been through the really heavy enforcement, not to get a false sense of security by what we faced the last 2 years. And if you haven't lived through that and you're operating, say, a Farm Bill compliant business where you're selling CBD and Delta 8 products, and the last 2 years there have been no issues, please understand that that is likely to change, and it's probably going to change very, very quickly. So right now we have a bill, Build Back Better, that passed the House of Representatives. In that bill, there is $88 billion in IRS funding, and $45 billion of that is specifically dedicated to enforcement actions. So the IRS is getting an increase in funding of about 70%. They're coming way back up to levels we haven't seen in over 10 years. And almost half of that, or more than half of that possibly, is going to be specifically dedicated to enforcement actions. After what I've seen in the cannabis industry dating back, 5+ years, I am confident that a big part of that enforcement is going to land right here in all of our labs. It's, in their mind, low-hanging fruit, and I think that it's a good place for them to find revenue, quite frankly. So my concern is that if this funding passes and they're able to ramp up and they really push enforcement, they're going to come into the cannabis industry, and I'm concerned about how that potentially impacts anyone selling Delta 8 products. So what does that really mean if you're in the industry right now and you're either manufacturing, wholesaling, or selling Delta 8? What do you need to be prepared for? What I would suggest is, at this point, let's get an understanding of what the possible ramifications could be. If you're prepared, even if you disagree with the position and you don't think that there's any way that this would ever apply to your business, it's good to at least know what would happen if it was applied to your business. So what I generally have been talking through with any of our clients who are currently involved in selling these products is, listen, let's at least understand where this could potentially go and make sure that you're prepared. So if 2 years from now we get a notice from the government that they intend to audit your 2021 tax return, we need to be prepared for what that could mean. And let's proactively take steps now to make sure that we're complying as much as we can with the code as it's written, and also taking proactive actions to segregate any components of your business that potentially cause risk from the components of your business that would not fall under these provisions. So if you are a manufacturer or a cultivator or manufacturer who are selling these products, if you looked at the example that we have earlier, your exposure is less than a lot of other people in the industry. So what we need to be prepared for really is that you're going to lose potentially some of your selling, distribution, or overhead expenses. We want to make sure that we've done a very good job buttoning up what your cost of goods sold are, what are really inventoriable costs, making sure that we're maximizing that where it makes sense, and that we're limiting the exposure then that you have to operating expenses. And then you at least know at this point, okay, if something were to happen and we would lose this pool of deductions, we think roughly here's how much the potential tax liability could be. Here's maybe what the interest could be. There could possibly be some penalties. This is just kind of what we have to be expecting in the event, even if it's remote, that there's some sort of enforcement. Not the best result, but at the same time, again, if that's the business line, the impact of 280E is going to be less than someone who's a standalone retailer. So if you're selling retail and it's completely web-based, the bigger concern there is, okay, what deductions are you going to lose? What are you paying for your inventory is really essentially what you're going to be able to deduct as a taxpayer if there were to be an action. And so are you paying for shipping to customers? If so, there's a potential that you could lose that deduction. What are your selling, your distribution expenses? What are the costs of the website? What are the overhead for accounting and other types of SG&A costs that go into the business? They're probably much more minimal when you're web-based, or they're definitely more minimal when you're web-based. Just be prepared that, again, we need to identify this pool of costs and recognize if these were to be disallowed. What does that mean for you, and what do you have to be prepared for? The last one is standalone retail, and this is where I think that I would have the greatest concern and the most with clients that we know that are in this space. We're spending a lot of time talking with them about this right now. So we really have come across two types of businesses that are in standalone retail that we have who are selling products, Delta 8 products. One is, the traditional farm compliant CBD retailers who are now also retailing Delta 8 products. That's, pretty natural progression of their business. And so, again, it's something we're going to look at to be prepared for, because that adjustment for them could potentially be significant. The second, and the retailers that are in the CBD space, I think a lot of times are at least familiar on some level that there are different tax laws that govern the cannabis industry depending on what you're doing. So they're a little bit familiar that this is out here, and it's a little bit easier of a conversation because they know that, hey, this is something that people in other aspects of the industry have to deal with. We can kind of talk through, if it were to apply to them, what would it mean? Whether they agree or disagree, at least have them prepared. The ones that concern me even more is we have a lot of people in completely non-cannabis related retail businesses that have entered the Delta 8 space. So, for example, you may have someone who owns convenience stores, and they own a multitude of convenience stores, multiple locations. They aren't really selling anything cannabis related, but now they're selling maybe CBD and Delta 8 products out of their retail space. My bigger concern is for them because most of the time when we have this conversation, they're not even aware that 280E exists. It's so far away from anything that's ever been applicable to their business model. It's not even a discussion they've ever had to have. And the people that work on our team within HBK generally haven't been talking with them because they're not in the cannabis industry. So a lot of times this first conversation is very eye-opening for them. And then it comes down to, looking at what's the risk versus the reward of continuing to sell the products. You can move to the next slide. So one of the things that I think we need to continue to consider and be aware of in the retail space in particular is one of the few favorable cases that the industry has had where the government didn't get what they wanted in tax court is Californians helping to alleviate medical problems. And it's called CHAMP. It was one of the first cases. And really what it laid out it was back in the days when California was still operating under the co-op system. People would come to this, I would call it we could call it a treatment center, a wellness center, whatever you want to call it, but they would come and there was a variety of services that they would provide to people suffering with severe medical conditions such as cancer. And only one of those was access to cannabis. So, they would come in, there would be different types of treatments they would offer. They could offer counseling. There were a lot of different things that they were offering to their members. It was essentially a membership that they charged. And as a result of that, they took the position that, listen, you're right, we do have a component of what we're doing that is selling or at least accepting in exchange for membership. We're providing cannabis to medical patients, but it's only a small part of what we're doing. And we can demonstrate that we have several other types of trades or businesses that are not related to trafficking any Schedule I controlled substance at all. And they were actually successful in this regard by demonstrating this. So maybe the silver lining here is that if you are a retailer and you can demonstrate that you have separate trades or business, then you may not have to worry about the application of 280E to your entire business. If you think about somebody who is in, for example, the convenience store business like we talked about, for them to be operating and having a small percentage of their revenue derived from selling, say, Delta 8, to getting an IRS adjustment there where they say 100% of all of your retail businesses are subjected to 280E, that could be the type of tax assessment that could put someone out of business and put them into bankruptcy. So this is probably the area where if you're going to continue to make the decision to sell these products, I would try to do as much as we can to demonstrate that we have a separate trade or business. So if you go to the next slide, you can see there's some things that we want to recommend that we do. And some of these may not be practical, and you may not do all of them. If you could do them all, then you have a much, much better case. But even if you can, I think that if you do some of these things, you start to demonstrate that you're acknowledging that these are separate trade or businesses and you're segregating them. So, do you have different books? Are you keeping separate accounting records? Are you sharing employees, sharing locations? The less that these two business lines are completely integrated, the better case that you have that they could operate independently from each other. And so, in a perfect world, we'd have you move all this to a different physical location, have separate employees, completely segregate anything that creates potential exposure from everything that we believe does not. For a practical matter, you may not be able to implement all of these changes, but if you at least come up with some sort of policies and try as much as you can to segregate sales of anything that potentially could trigger the application of 280E from everything that we're 100% sure will not, it's a much better position to be in, and to do it proactively is really, I think, the only way that you're going to be able to take this position. To try to do it retroactively once the assessment's been made, I think we end up in a very difficult spot and probably won't be able to make a very solid case that's going to get through the service. You can go to the next slide. So if you can demonstrate that you conduct activities that constitute separate trades or businesses, the expenses allocable to those will be deductible. So, in the example of the convenience store, if we're able to do that, we're going to take a very small hit for whatever the sales of Delta 8 create. Whatever allocation we would have to make to those, we're going to lose some deductions, but it's probably not going to be a huge adjustment and something that's going to be manageable. But in order to do that, we have to be able to make the case. And if you're not even aware that it's a potential issue, you're not going to proactively set procedures, processes, and controls in place that allow us to very easily demonstrate that we've made every effort to make these a separate trade or business. We'll go to the last poll question. And this kind of goes back to my example. Are you currently selling any of these products as part of a larger retail business that really specializes in selling non-cannabis related items? Okay, so there's nobody on this morning that has run into this issue. That's good. And, again, if you are in the retail space, the retail CBD space, same thing. I mean, I think we have an opportunity here to segregate that as much as possible and sort of provide some buffer of protection proactively, regardless of whether this ever comes to fruition or not. And I think it's something that really isn't, it's not going to cost you a lot. It's going to be maybe a little bit more work on your end that can be tedious at times, but I would think, it's worth it to sort of insulate yourselves from the potential of this being an adjustment to your whole business. I think we have a little bit less than 10 minutes left, so I'll open it up for any questions anyone has.
We did just receive a question. The question is, how do you expect the IRS to approach potential enforcement around the sales of Delta 8 THC?
That's a great question. And, I kind of said this at the very beginning of the presentation. I'll reinforce it now. I can never really give definitive answers as to what's going to happen. This is all so new and it's so inconsistent. I will say from prior experience. So the answer is I don't really know what they'll do. From prior experience, they've been very aggressive in their enforcement and they've taken highly antagonistic positions towards the taxpayer. So if prior history is the best predictor of future behavior, I expect them to take an all or nothing approach and push it back on the taxpayer to try to demonstrate that they don't have these adjustments under 280E. That's what I would expect, unless there's something that completely removes Delta 8 from Schedule 1. If they do move to enforce, I expect them to be very aggressive, and we're going to have to probably push back pretty hard. I don't expect them to be practical or fair. I think at one point there was a court case called Alternative Healthcare that was really unfair and brutal towards management companies, and the taxpayer said, listen, this is really unfair. And the tax court said, you're right, we agree it's unfair, but this is what the law says, this is what the statute says, and you should elect different legislators if you don't like it. And that's how they left it. So that's just my opinion, but I don't really know.
Okay, the next question that came in is, as more cannabinoids are discovered and processed, how will these be affected by the Irc Section 280E?
I think, again, it's going to be the same as what we're dealing with here. I think there's going to be, until we get some real clarity on what is Schedule 1 and what's not, I think we're going to continue to operate in sort of this area of confusion and gray area. And until that happens, I would just approach anything new that comes to market, whether it's a Delta 10 THC product, sort of the same way. I'd continue to hope for the best and just be prepared in the unfortunate event that the worst happens, what that means.
I think we have a time for another one. Other one that came in is, what advice are you giving clients who are selling Delta 8 THC products?
It really depends on what their business is, what they're doing. If it's, we have clients that are 100% all into the industry, so we're just having these conversations to make sure that we're doing everything we can proactively to put them in the best position to be successful and protect their business. When we're working with someone maybe who's a completely non-cannabis related retailer and they're selling some of these products and it's a small component of their business, we're having the same conversations, and they're basically working through it and deciding from a business standpoint what makes sense for us. Are we better off to continue to sell these products? Is it not worth the risk? It's just having those conversations. There's so much ambiguity. There's differing opinions on what all this means. I'm sure you could go out and find other CPAs who will tell you maybe this is a complete non-issue whatsoever. So we're just continuing to talk about, what if there's an approach here by the government that really is tough on Delta 8 sales overall, what is that going to mean? And what should you be prepared for and make business decisions accordingly? So those are sort of the conversations that we've been having. Just try to make sure that our clients are educated and they're not surprised. Okay, well, thank you very much for attending. Really appreciate everyone making the time, and have a great holiday, have a great New Year, and we'll all talk soon.